So today we're coming to you with a little something different. Rather than talking to a GP in the business, we're talking to somebody whose business it is to help LPs figure out what they should be doing in this investment world. Really happy to introduce somebody I followed on LinkedIn for a long time, but only gotten to meet right now. You're watching this live or listening to this live, first time we're ever talking. Alexi, welcome to the show.
Hi, Jonathan. Thank you so much for having me. It's a pleasure to meet finally.
So would you just tell people, like in a nutshell, what it is that you do for what is your business right now?
Yeah, so I spend all of my time full time on advising existing LPs and future LPs. So existing LPs are just folks that have existing passive investments in real estate or perhaps other vehicles. And then future ones are just folks that have capital to place and perhaps they have a deck or some interesting opportunity and they would like to get some independent feedback on it.
So how does that actually work? I mean, w people have a deal and they say, "Hey, Alexi, I'm thinking about this deal, but I don't really understand it, so I'd like you to advise me." Well, like, just walk me through actually what happens with your clients.
Yeah, totally. I mean, typically it depends on sort of like the level of engagement that the LP wants. But typically it's just they send me a deck and I send them some feedback on it. And I never say whether they should invest or not. I very much believe that that's sort of their decision. I view my job as helping them unpack the deal and kind of explain what's not on the slides, so to speak, which as you know, like sometimes there's more that's not on the slides than is on the slides. And I sort of like try to unpack that for them, and then they receive my deliverable, and at that point, you typically have like a binary response from the LP. Either they look at it and be like, "Wow, I had no idea any of this was here. I'm not ready for this. And I thought, real estate was risk free or, whatever, or everyone needs a place to live type of thing, right? And like this helped me understand that this might not be true. Or the other response that happens all the time is this is super helpful. Like you helped me um, understand a few more things that I wasn't thinking about it. Let me just go to the GP, ask those questions, and many times those answers come back very good and from the GP, and they end up investing.
So, like, what kinds of things are you pointing out to them that, aren't there, for example?
Yeah, so the deliverable is using my three pillar framework. I sort of view LP, and this is just something I authored. It's not anything I guess that you can find elsewhere. But I thought long and hard about how LP investments should be thought of from the perspective of an LP, and so I came up with a three pillar framework. The first pillar is execution. In other words, does the GP have the ability to execute, which is a function of track record, a function of actual experience with that specific asset class, let's say, or that size of asset class, and many other things. Another part in there is just the ability to trust them. Do they seem like um, the responsible people, so to speak, or perhaps have they gotten in trouble before, and that's something important to consider. The second thing is alignment of interests, which is kind of like a three-pronged approach between the co-invest from the GP, right? The waterfall that's presented, i.e. the economics in the deal, and then also the fees. What fees are involved and are they market or not? Um, and then the third thing is the actual property. So I think sometimes people get surprised that I put property third, but I think it's very much meant to be third. In my opinion, at least, because I think in many cases the first two pillars just don't really pass. In other words, you might have a property that is very promising, right, as an investment standalone. But let's say you can't trust the GP, or the GP doesn't have the experience to actually carry out such a plan. And due to the increased execution risk or the misalignment of interests, the LP investment just doesn't make sense.
So when you mentioned a moment ago, sort of the trust factor, do you actually do background checks into the LPs that, I mean, I'm sure you're not doing like a criminal background check because that costs money, or maybe you are, but are you Googling them? Like, how are you ascertaining the reputation, or as you said, like whether they've been in trouble before?
Yeah, so two things. I do run background checks, depending on sort of like the package that people choose. Um, I think more importantly, a lot of the data that I have is internal. In other words, I hear from a bunch of LPs that are existing LPs in funds and in deals with GPs. And for instance, it's not too uncommon for an LP to reach out to me and say, "Hey, I'm thinking about investing with GP so and so, and look at the deck." So I open the deck, and the deck says, "Look at us, like we have this amazing portfolio, everything is healthy, and it's a 2x return, and we're projecting a 2.5 on the future stuff, right?" And I check my notes, and 2 weeks ago I spoke to someone who got a capital call, and there's almost 100% chance of that property losing all of its equity, right? And so in such instances, I mean, I'm under a confidentiality agreement with the LP, and so at that instance, I'm comfortable saying, "Look, like I can't share what the LP sent you me, right? But what I can tell you is one of the properties in the slide is not going to be a 3x return with decent probability. In fact, like 90% and above, let's say. And I think that's important, right? Like you want to deal with a GP that's honest. And I think in many ways, being honest about some of your challenges is a really amazing way to build trust. I think, but I don't find it often.
I mean, this isn't a question I was going to ask yet, but since we're talking about this, what as a GP, and I know that there are GPs listening to this, if you have had trouble with a deal, what's the best way to kind of be forthright about that? Because clearly, I think a lot of people are they're very binary in the way that they think. They think they have to be perfect,
Yeah.
or they go to zero, right? And I think maybe that is responsible for why people are less than forthcoming about things that didn't go so well, because they're so concerned that like any chink in the armor means they're out of business, which I don't think is true. But what is the best way
Right.
for a GP to handle, because life is complicated, right? And deals don't always go well. So what's the best way for GPs to be forthcoming about that?
Yeah, I mean, I think I would say honesty and transparency, and I would say the earlier the better. I think being a GP is a long game, right? And you really want your LPs to reinvest. Like, why invest in finding another LP when you already have one, right? Um, and a lot of times I just see GPs not communicate well enough. You know, just too late, right? And it surprises people. You want to essentially minimize surprise, as with all relationships. It's not just this. Yeah, that's the biggest thing that I would point to, I think. And to your overall point, I totally agree that people make mistakes, and I always tell LPs like that, there's nothing wrong with defaulting on a deal. I do think there's something wrong about defaulting on a deal and then turning around and showing a deck that's perfect and either taking that property off completely, right? Pretending like you never owned it, which I've seen, or pretending like everything is fine, which I've also seen, right? So like there I think there's like an interesting ethical code, so to speak, which is very on defined, right? Like there's no real ethics here. It's sort of up to the person, and I think LPs need to realize that, and GPs as well. And I think there's a big opportunity to, in many cases, just even to showcase deal that was challenging and how you came about it, and maybe you were only able to recover 80%, let's say, of LP capital, but like here's 2 pages on what happened and what you did. And one thing I always tell LPs too is, if you bought a deal in 2007 and you sold it in 2009 or 10, and you made most of the equity back, I mean, that should be celebrated, right? On the other hand, if you bought a deal, let's say in um 2019 and sold it in 2021, and you're celebrating a 1.5x, many times it probably should have been higher. And perhaps it was only a 1.5x, so to speak, because of cap rate compression. And if you sort of dig into the details, your NOI value add plan didn't really work out. And it was, where you started. So I think there's both sides to this.
But in terms of, I mean, you did mention sort of the communication during a deal, which I think is very
Yeah.
important. And I'm always surprised to hear, I've heard in talking to my LPs, I never, people will come to me. I usually interview them, and when they come in and I say, have you invested in deals before? And they say, yes, I have. And I'll ask them, but I never ask them who. I don't really want to know who they invest with, but I just want to know, but I want to know what their experience has been like. And I'm very surprised when people tell me, well, they'll ask me a question like, well, how often do you communicate? And I'll tell them the schedule that we usually communicate on. It's a monthly, we report monthly, but if anything comes up, we tell you right away, kind of thing. And sometimes
Yeah.
we'll give you extra reports. Like if I'm at the property and I see something that's I want to report on, I'll report additionally on that as well, just because I think you want to know.
Yeah.
But they'll tell me, oh, that's great because I am in this deal and I never heard from the guy again after investing, and which just shocks me that people would do that.
Yeah.
But I guess, I mean, do you find that that's not uncommon in the business?
I mean, I think it's very common to not get monthly reports. I also tell LPs that the frequency doesn't really matter. I think what really matters is the quality, right? And I think you'll appreciate this. I mean, I've seen reports that come out monthly, but like it's talking about the progress at the dog park. Instead of actually like addressing the fact that next month your rate cap expires and all your equity is gone. Right? And I'm not, trying to be negative, but like I've seen these reports, and like there's monthly updates. One is about the dog park, the next one is about, painting and how nice things look, but you're just avoiding the real topics, right? And to many LPs, they don't, in some cases they don't remember the real topics. They understood them in the beginning, but they just forgot. And in many cases they just don't know, right? Many calls that I get are from LPs, and they said, hey, I got a capital call, I put in $1 million into this deal, and to be honest, I'm not even sure what a capital call is, can you help? Right? And so the first discussion is explaining to them what a capital call is and the sort of like where the property stands, based on my best estimates and what the reporting has given them. But the second topic is not always, but certainly in some cases, when a capital call arrives, your equity is impaired, right? And that's a very difficult conversation, right? Because if if an LP is finding out about the fact that their $1 million is worth 250 today from a third party advisor, um, instead of your partner, I guess it's just less than ideal.
Yeah, but you want to hear it directly from the partner, right? Just as a GP, I would never want my LPs to hear something from someone else before they hear
Yeah,
it
for
from
sure.
me. Like
Yeah, absolutely. Yeah. Yeah.
I'd be embarrassed if that were the case.
Yeah.
So, but then in terms of, so that's one side of the communication, but the other side, kind of just circling back to where we started. If
Yeah.
you have, let's say you're presenting a deck to LPs and you have a deal or two that were troubled, sort of how do you present that in your deck, in a way that is forthright? Um,
Yeah.
and
Um, Look, again, there's no rules. If you're asking me for what I would do, I think difficulty in many ways, I think LPs connect, and people in general, as just a general rule, I think they connect to people's difficulties rather than their wins, and so that's a nice emotional thing, right? That can be used in your advantage, so to speak. In terms of how to actually present it, I think I would say the baseline is don't leave it off the deck, right? Meaning if you're presenting a track record slide and everything is 2x and 3x, it's okay if there's 1x or perhaps 0.5x, right? Um, uh, of course, when someone sees that, they will likely go, oh, that's interesting. Like, it's awesome that they actually were honest about that. what happened, right? And so to preempt that question, you can make a decision. Either you handle that probably on almost every single LP call that looked at that slide, right? Or you can create a slide on it or two slides that explain like, here's a case study of what happened, right? Almost like a postmortem analysis on we bought it and this is what we learned and here's where we could have done better. And I really think that would go a long way. I mean, to your point, I guess you could argue it's easier to fundraise when everything is perfect.
Mm.
But the reality is like generally investing is not perfect. People make mistakes, and I think LPs and GPs know that.
I mean, I do think that you connect much better when the person that you're dealing with is uh is more human, and that means that they have exposed some of the negative things that have gone on with their,
Yeah,
it's like when somebody is telling their like hero story, right? And everything is perfect. It's always been great. They've always been good at this. It's actually pretty dull. It's much more
mhm,
interesting when you hear about some struggle that they had, that they
right,
overcame, they learned something
right.
from. And I think that the same goes for GPs. So what it's interesting what you're saying. This is the direction I thought this conversation was going to go. You're talking a little bit about like the storytelling aspect of being a GP, but I guess it really is important for
I think
building
it is,
trust. Yeah.
and I'll tell you just one more thing. Obviously, happy to take the conversation wherever you want, but I I've had multiple cases of like LPs asking me for feedback on the deck. I would give them feedback, and there was sort of like this elephant in the room, right? That was either hidden or missing, or just blatantly, I guess you could say, lied about in terms of valuation. Um, and so the LP would reach out to the GP, like they would have a call or whatever, and they would ask them. And at that point, like one of two things happen. Either the GP just kind of breaks down and be like, well, crap, like you're right. Like it was so frustrating and like I really screwed up. And here's what happened. Or the other route is like, oh, that wasn't really my deal. Like I was on it with someone else and like it was really their fault and like it doesn't really matter. It's not part of the comps. And so in the latter, I've never seen a case of an LP coming out of that conversation and investing.
Mm.
In the former, I've actually seen some, meaning like you kind of screwed up a little bit by like, hiding something, which is not unideal. But then the crazy thing is like by being open about it and by talking about it, you actually opened up to the person. And all of a sudden, like the LPs feel like they're part of the story. They understand what happened. They feel like they know you better. And, they can relate because they're not perfect either.
Yeah, years ago, I don't even remember who it was who told me this, but when I first got started, I remember somebody saying something to me along the lines of, I don't care if you've had bad results, like sometimes. What I care about is whether you learned something from that or not. And if
Right.
you and if you can
Yeah.
show me that, yeah, you had this deal, it went badly, but you learned a lot from it. And now I know that like essentially like you learned that mistake on somebody else's money, not on my money. That
Mhm.
kind of makes them feel actually a bit better. Like you have been through some struggles and you learn from them and
Yeah.
you won't repeat at least those mistakes again. So uh,
Right.
yeah.
Yeah, and now I just add a little bit more. On Twitter and LinkedIn, there's like I see some posts sometimes that are like something along the lines of, if a GP defaults on something or loses investor capital, they should never invest again, or like that sort of narrative. And I'm just like, you can't say that, right? Because everything depends on the context. Like if if someone does 100 deals and two X's on average, and then screws up on one deal, like you can't compare that to someone who has lost 10 deals and this is their 11th, right?
Mhm.
And even in such a scenario of like where this is like the 11th straight loss, I mean, people can do whatever they want. The question is, does the LP understand what they're getting into and did their proper due diligence. Again, there's sort of some gray area here because presumably they're not raising money on each deal by presenting their track record of losing on each deal, right? But I think you get what I mean.
Yeah, absolutely. So, under what circumstances do people come to you typically? Or who is like your typical LP? Are people coming
Mhm.
to you when they're making a $50,000 investment, or is it really people coming to you who are making, seven-figure investments who are looking for your advice?
So I think the answer is both.
Mhm.
And actually, I've seen some evolvement in my inbound requests in the sense over the past like 2, 3 months. I think most people are what you would consider traditional retail. I don't see so many 50,000 checks. Um, I see more like 100 grand, 200, 500 in some cases. I have advised a few like million and above. Um, so that sort of tends to go to like, you think of your doctor, dentist, attorney, right, engineer. I've had a lot of customers or clients that were developers, for example. Um, and so those folks, like they have a few 100 grand to place and they just want a second eye before making a mistake. Recently, I've actually had a lot of conversations with pretty big allocators and very large family offices that might have like 40 or 60 positions. And I think what I'm slowly realizing is I'm kind of like building an interesting data set, from all of my work. And someone with a lot of positions, whether it's on their existing portfolio or potentially investing again, could benefit from speaking to me as well. So it's not necessarily a client that I was expecting in the beginning, right? Because they typically have like the horsepower internally to analyze well. But I think we're starting to connect and talk about stuff. So it's been very interesting.
And so I guess sort of one sort of obvious question about this is, well, I mean, how do you make money? This is like a fee for service kind of advisement that you do. You
Yeah,
charge a fee and you just break down the deck or what have you, or share your
that's right.
advice with your
Yeah,
clients.
yeah, yeah. It depends on what the request is, but either I do a flat fee in most cases, or I charge hourly if it's like sort of, for example, on capital calls, people ask me like, how much does it cost? And I can never give them a cost because in some cases I get on a phone call and within 15 minutes I can tell that regardless of the deal and its economics, this doesn't make sense. Just to give you an example, like a few weeks ago, I get on a call and I ask them, do you have the money? Like for the capital call,
Mhm.
that's the first question in my mind. And they're like, well, sort of. And I'm like, what does that mean? Well, I think I'm going to borrow against my 401k. It's like, well, okay. So that just became more complicated. And I just want you to realize that because you have to pay that with interest, right? Or if you borrow it from someone else. So meaning the hurdle, so to speak, on the reinvestment decision becomes higher. Do you understand that? And they're like, oh, I didn't think about that. So maybe it's not even worth it to think about it. Right. So in some cases, it's a very easy decision. In some cases, especially with like larger dollar amounts, especially in cases where like, the dilution of not investing is very severe, right? It becomes a more complex decision, in which case I have to sort of go hour bound.
So, I mean, we're hearing these days lots of capital calls in the air. If you could take sort of a stab at it, what would you say, just as a gross percentage of the capital calls that you've seen, do you, in your opinion, was it worth responding to the capital call? Like I've been hearing sort of scuttlebutt about, you know, some capital calls being like, well, you're just throwing good money after bad, basically. Like this
Mhm.
capital call is not going to save the deal, so you should just, bite the bullet and
Yeah.
write off your loss. But some of them are legitimate, like
Yeah, yeah,
this
for
is
sure.
there's a plan here. The plan seems very reasonable and well thought out, and
Yes.
it's worth taking the additional risk. So in those two buckets, of the capital calls you've seen, what percentage sort of falls into each one of those, would you guess?
I think about like 70-30 probably.
Which
S-
direction, good or bad?
70 being not ones that I would think are logical. Again, even with capital calls, I never tell people what to do. But what I try to do is sort of direct them on the facts. Like in other words, like here's where your equity stands today within a range, um, and explain to them how it might be impaired, right? Here's how it might be difficult to get to the business plan that the capital call is proposing. And like they can sort of attribute their own probabilities to those things occurring, but I try to walk them through the process to make sure that they can make um, educated decisions.
Yeah. I mean, this is more a general question about sort of what does the market look like to you right now, as opposed to how you would advise people per se, but just sort of what you're seeing out there as a general matter in terms of the the I guess the degree of distress that you're seeing right now. What are you, so what's
Um,
your view of that?
it's a complicated topic because I think and I speak about this publicly a lot. I think I have a very biased sample size, because the LPs that don't need my help on average probably invested better, just on
Mhm.
average, right? I'm not necessarily, it's not always true, right? But the folks that are reaching out to me, they also don't reach out when, things are average and maybe they can figure out. They tend to reach out when things are bad,
Mm.
right? And so um look, the real estate market is massive, right? I think anything um I guess the other thing also, it's not just biased in that sample in terms of that perspective. That the other bias I think within my world is I mostly deal with syndications, mostly,
Mhm.
not always, but and so if you look at all the money that was raised, that was syndicated over the past, let's say between 19 and 2022, I don't actually know the number. If you've ever seen it, please let me know. But I would guess it was probably like 70% multifamily. I
Mhm.
think it's very high percentage multifamily versus office and industrial and all the other things. So sometimes people ask me a question like, what percent of the deals that want, half capital calls are multifamily? And the answer is it's pretty high. It's probably 70, 80. But also it might not mean much because of the original, deal volume
Mhm.
that was raised, most of it was multifamily, right? So it's almost expected.
So how did you get into this business? I mean, I don't know, maybe there are other people out there doing what you do, but you're the first person I've encountered who does this, just, purely LP advisory. So how did you come into this business?
Um, I just started it.
Yeah, I know. Well, yeah, but
Yeah,
but
yeah.
that's the
I
obvious
mean,
answer. What I mean is like, why did you do this? Why
yeah,
did you
yeah, yeah,
decide
totally.
this is a good
I
idea?
mean, so my background, I was at a REIT and my job was to look at, in some cases, dozens of deals per week. I ran a 20-person investment team and we to look at a bunch of deals and more than anything, the goal was always, does this look okay? Do we need to restructure it? That would be sort of like the second bucket, and I would get involved and help them think about what mitigants we should put in place to make the alignment of interests between us and in our cases the tenant, make sense. And then in some cases we just passed right away, right? And so I really enjoyed that. That's sort of I guess fact one. Fact two is I had an experience with a syndicator that kind of opened my eyes to this world. And that started kind of a process in my head about, I wonder what's happening in the space at a larger scale. And then I would just get decks from people that were like, hey, can I bug you to give me some feedback on this? I'm thinking about investing 500 grand. I would give them some feedback, Jonathan, in what I would consider to be, like real estate 101 language. Um, and the response I would get is like, "Oh, that's so helpful, thank you. But can you remind me what a cap rate is?" And and then at that point, I was like, "Hmm." I mean, I was just sitting there, and I realized maybe this is the norm. Like when you think about it, it kind of makes sense, right? Like you have a lot of people who have made money typically outside of investments, right? Businesses or whatnot. And they're just trying to preserve it and not screw up. Real estate is a generally good place to put it. Um, but they don't necessarily have the what I would call a, like a healthy dose of skepticism, right? To approach some of these deals and ask the right questions. I just launched, and here we are.
It's how long ago was that?
6 months ago.
That's it, really?
Yeah, yeah.
Oh, wow. And so how many people do you think you've advised in that time? Do you have a ballpark number?
In terms of conversations, definitely in the hundreds. In terms of engagements, I wasn't keeping track in the beginning. My guess is probably 50, probably more.
So I'm very curious about how you, so this is so surprising to me because I follow you on LinkedIn and your commentary is really good, really thoughtful. And you speak with a lot of authority. I mean, obviously you have a deep background in real estate, so it's not like you just came out of nowhere to start this business. But I just sort of assumed that you'd been around a lot longer because of the following you've garnered and everything. I'm curious about how sort of switching gears a little bit about how
Yeah.
you've grown the business, even though it has just started fairly recently. What's been your approach to growing it? I know you're very active on LinkedIn. Is that your primary source of leads, or do you do other things? Why don't you walk me through that a little
Um,
bit?
yeah, I mean, the entire business was launched on Twitter, actually, not
Mhm.
LinkedIn. I actually was not so active on LinkedIn until maybe 3 months ago or something like that. I think to date, life to date, so to speak, I would say probably 80% of my revenue came from Twitter, 20 being LinkedIn. And the strategy to growth has just been posting my thoughts. That's really it. Like I do zero advertising. I don't reach out to anyone for like yeah, I never like cold email LPs or blast a list talking about my services. I just share what I'm seeing, and folks that think it's valuable follow me, and if they have something actionable they need help with, they reach out. And I think another thing that has helped is pretty early on. I also realized that there's no, well, I guess you can call it like an active publication, that talks directly to LPs. And so I started that. And I think as of this morning, I was at 3340, 3350
Mm.
or so subscribers. The vast majority of those are LPs. And, that has been great too, because it gives folks like a way to learn. And some of those people just don't have the liquidity to invest and they want to learn. Some of those people are like, a software engineer at Google at 25 years old, thinking about becoming an LP in 2, 3 years, but not ready yet. Right. And so I sort of share what I see and see what happens.
Is that a paid or a free newsletter?
So I have a paid version. I write twice a week.
Mm.
And so every Friday I send out a digest of what I think are like really interesting topics for LPs. That one is free. And typically like Wednesday to Thursday-ish, I will send a deep dive on a given topic, typically something with a full model, a deep dive on capital calls. I've done, I don't know, probably like 30 of these or something like
Mm.
that. And so those are paid, and you know, uh, many people have decided to pay, and it's been amazing seeing it grow.
And what kind of topics do you talk about in both of these newsletters?
Just things that I see, right,
Mm.
in always in an anonymous way, right? But the newsletter is called LP Investing Lessons, right? And the whole purpose was, if I'm seeing existing LPs struggling, right? You can always sort of tease out, in a very anonymous way, things that can help a new LP learn to not make the same mistakes, right? So that's the whole theme
Mm.
behind the newsletter. And topics range everything from, like I said, I think I've done 3 separate articles on capital calls, all touching sort of like different aspects. I've done full diligence list for GPs. Probably one of the most famous articles is, and this one is actually free for anyone who wants to check it out. It's called Top 15 Syndication Mistakes, which was essentially sort of my digest of, if some LP lost their money and you go back to the original deck and look at it, what things could have made it a little bit more apparent that this was more riskier than they thought.
I mean, so tell me, like, what are some things, that come to mind, like obvious mistakes that could have been caught,
Yeah.
that stand out?
Um, sure. I always like to, and I write about this in an article. Um, I think mistakes sort of come um in packs. Okay. In other words, some of the things you'll see in the article, for example, Jonathan, are like, if you see a split, that's 50-50, right? Like that's generally speaking off market. Now, both you and I know that doesn't tell the whole story, because if the pref is 12%, then maybe it is okay, right? So meaning, what I tell them is you need to like take this list and think about them as reasons to stop and think, right? Not necessarily reason like red flags. I really don't
Mm.
like that phrase. Um, right. And so what happens typically is you'll have a combination of these reasons to stop and think, and you'll typically have like three or four, right? And so many times it'll include um, like misaligned incentives, which could include, like a split that's unfair, no pref, in some cases, no co-invest, right? And many times no experience to actually run this project, right? And so, when you see two to three of these, you always sort of search for an offset, right? But maybe X, Y, and Z compensate for the fact that this might be a little bit riskier, right? Or less economically beneficial to me, right? As an LP. But what you started realizing is at some point you reach a fourth and a fifth, right? And you can't find anything to like properly mitigate those things, and I think at some point you end up passing, which is sort of like the whole point of that article.
Do you also advise GPs on how to better present themselves, or, um, y- yeah, or even to be better GPs, I suppose? I mean, do you have that kind of offering as well?
Yeah, so I've like kept very careful, it's not distance, like that's not the right word, like careful um engagements, I guess. I don't know
Mm.
what the right word is. With GPs I'm very careful, right? I think I probably get 5 to 10 requests a day on like capital introductions, for example,
Mm.
and I just immediately say I can't do it, because in my opinion my whole um value proposition is that I'm independent, and so
Yeah.
if a given GP pays me for a raise, I'm going to sort of at least feel
You may lose your objectivity.
yeah, yeah.
Yeah.
I may feel more excited, so to speak, about that
Right.
deal about versus another, and I don't like that. Even if I disclose it and all the legal stuff, it just ethically it doesn't feel right. And so the two things that I do for GPs now are I give feedback on decks. So like if a GP wants to send me a deck, I charge a flat fee and give them feedback on every single slide in terms of what is on that slide and what I think should be in the slide or perhaps another slide. And the second thing is, kind of ethical issues, as you said, like if they're concerned about a certain communication, maybe there's a capital call coming up, they don't know how to think about it. Maybe there's a disagreement among GPs, and they're trying to, figure out how to think about something, and I'll typically do those on an hourly basis.
So, uh, I guess this has been really interesting. We're kind of running out of time. I think I could talk to you about this for much, much longer, but I'm curious if you have any, to the extent that you're at liberty to share, any kind of like real war stories or really egregious things that you've seen, um, you know, just anything sort of shocking that you've encountered during this time that you've been helping LPs sort of understand what they're getting into?
Um, yeah, I mean, I think the most shocking things are the number of bullet points on the top 15 red flags, or top 15 syndication mistakes article. In other words, I've seen cases where I think I've seen cases where 10 of them were present in a
Mm.
single deal. maybe more. I don't know. And so that was the whole purpose of that article is, when you see one, probably fine. Like you could totally have a 50-50 split and still be a phenomenal deal with someone who has a ton of experience and has a good pref and whatever. But I really try to get one of the reasons why I try not to share this is because what tends to happen, and I did share it once, and then I heard from an LP was like, "Oh man, like I heard you say about the 50-50 split, and I just saw one and I passed." And I'm like, "That is not what you were supposed to do, right? Because that's just one variable. Just like you don't judge a deal by its IRR, right? And in many ways, I think it's extremely faulty to do that because you're essentially self-selecting out the more conservative people
Mm.
potentially and getting all the more aggressive underwriters in your inbox. So too, like you shouldn't focus on the split and pass based on that. It all depends on context.
I mean, it's funny. I've been on the receiving end of that with a crowdfunding platform that shall not be named, where they refused to list a deal that we were doing because they said the IRR is not high enough. And I said, well, look, I can change my exit assumption if you want to make it
Yeah,
higher. Like I can manipulate the data any way you want, but this is an IRR that I think is legitimate, that I really think I can hit. And it's conservative and I don't want to stretch and overpromise. Then of course within months, I was seeing deals on their platform that had exactly the same IRR that I had projected. But
yeah,
I found that very frustrating that to get penalized for being conservative really made no
yeah,
sense to me at all. Um,
yeah. And that's I think a part of my role in this marketplace, I think, is try to tell LPs like don't do that. I just think look, if you're an allocator that sees 100 deals per day, right, and you have way too much stuff to look at, sure. I mean, you can filter by IRR, and then you still have 100 deals to look at any given month. Okay, right? But if you're the average retail investor, I think it's a massive mistake to look at like one variable. Like, you can pick whatever variable that is: co-invest, IRR, splits, acquisition fee, like all the hot topics. You see a 6% acquisition fee and you run. I don't know, not sure. It's high, right? But did you see the rest of the deal, right?
right.
It's just it's they're complicated topics, and people tend to want to be passive about it on the front end. And I just try to remind them that passive investments that are good typically start very active.
Right.
um or perhaps you just get lucky, right?
You can't outsource everything. You can't outsource all of your thinking about the deal,
Right,
right? You can
exactly,
outsource the
exactly.
execution of the deal, but you can't outsource the thinking
The
about
original
whether should
thinking,
invest.
yeah,
Yeah.
and that's exactly my point. To like, sometimes I'll get calls that are like, "Hey, I have a $10 million exit. Can you tell me where to put the money?" So first of all, I don't do that. Second of all, I just say like, I don't know if LP investing is for you because you just mentioned that you don't have time, and these things will take time, and so you can just blindly put it into somewhere, but then you might as well, I don't want to say go gamble, but like, and just put it into an index fund, like you have to put the time in, and if you don't want to do that, then it's probably not the right time for you.
So last question I have is, what are the kind of two or three things LPs really ought to be looking out for? If you could, just name a couple, and then hopefully they'll go and subscribe to your list and learn all about it. But just quickly, a couple of things that you
Um,
think they should really have an eye out for.
I think I guess in order of magnitude, so to speak, yeah, the first one is probably exit cap rate assumptions are big, and I think a lot of what's happening right now in the distress space is a result of expecting cap rates to continue compressing. Um, and so I always say this again, like there's nothing wrong with investing in a deal with cap rate compression as long as you realize that you're investing in a deal with cap rate compression. and you know that that's a macro bet as opposed to like something that the GP can control, right? And you also understand what happens to your investment if that compression does not occur, right? So that's the first one. I think the second one nowadays I'm seeing a lot is like what I would call overly aggressive refi assumptions.
Mm.
Um, it's so hard to predict where anything is going to go, and I think if a GP is confident in it, that in itself, I think, might be a reason to pause and think, the smartest economists can't figure it out, and so you know, if you're making 100% of your money back, so to speak, per the deck in 2 years, then I would carefully examine sort of like the assumptions in that refi, and that's certainly the NOI, right, and the valuation that you're attributing to that NOI in terms of the cap rate, but it's also like the LTV, right, and the interest rate, and a lot of these things sort of they tend to, Jonathan, they tend to just not appear in the deck. Like
Mm.
it'll just say like, oh yeah, in 2 years you're gonna get your capital back, and here's how the cash flow looks, but they don't explain to you what assumptions were made to get there.
So I guess the lesson is if it looks too good to be true, you need to dig a little deeper.
Yeah,
Mm.
yeah, and I would also say if it doesn't look incredibly good, you should also dig deeper. That's the hard thing about this investment. Is like people see a 10% IRR, and I hear from GPs all the time complaining about this. It's like they see 10% and they want to pass, but I tell them like this 10% that you just passed on might be the real 20%. And the 20% that you like let slip into your inbox and you invested in is actually in probability it's likely a 10, you know? And so IRRs are just, I mean, it's like literally changing one number in a model and everything changes and looks greater or worse, right? So I think LPs need to understand how sensitive things are to that.
Absolutely. Well, listen, this has been really wonderful. I really appreciate the time you spent here today. Um, could you once again give the folks listening the place to go to subscribe to your free newsletter or your paid
Yeah,
one
for
if they
sure.
want to, but I'm assuming they'll go free
Yeah, yeah,
first and then
it's
paid?
all it's all
Yeah.
it's all on one place. Yeah, so it's called lplessons.substack.com. And you can find me on social media too. So far I'm only on Twitter and LinkedIn, and you can just Google my name. It's not so hard to find me.
Well, thanks again. I really highly encourage everybody to follow Aleksey. His content is really good. I've learned a lot from him. I really love the way that he thinks. And I hope that you'll go follow him on LinkedIn or Twitter and go to his website as well. So, Aleksey, once again, thanks very much for your time today.
Thanks for having me. I appreciate it.